So I've been doing complementary currencies since about 2004 when I set out to write software for Let's. Hopefully, most of you will know that Let's is a local exchange trading system. Some of you will know the name of Michael Linton. In a Let's, what the people do is they exchange things with each other. They do things for each other, and they keep a ledger to ensure that the exchange is complete. I'll explain that a bit more later on. But there are Let's communities all over Canada, Australia, United States, Britain, France, Germany, with different names and in different forms. So I set out to write software for that in an open source way in the hope of supporting the whole movement. In the end, if this is the end, there's about 300 communities, but mostly only French-speaking, using my software. While I was doing that, struggling with trying to design the currency design page, the settings form for a currency, I went down the rabbit hole thinking about what money actually was. And in 2015, published the Money and Society MOOC with Jem Bendel, and I'll provide the link to that at the end. But meanwhile, the journey of money covered subjects like not only economics, but sociology, systems theory, politics, software, philosophy. And I've had a lot of experience thinking about users and groups and grassroots communities. So in the scope of Hollow and the way that Art Brock and Eric Harris Brown talk, a currency can be very many things, a measure of any kind of flow. And in my work, starting with the Let's, I've always focused on what they would call monetary currencies and what I call money for exchange. And I'll explain why that is a bit later. In this talk, I'm not assuming a knowledge of economics. And before I get going, I just want to give credit to some of my influences. So Tom Greco set me off with his book, The End of Money and the Future of Civilization. Also, E.C. Regal made an audio book of his work. Money as Debt, the online animation you will have seen. Another book called The End of Finance, which brought me on several years. And also a shout out to Michael Hudson, who I've always appreciated because he tells the story of money as a war between creditors and debtors. The Money and Society MOOC is much more academic in its references. This is a course about currency design, and I just want to throw a spanner in the works right at the beginning and suggest that very rarely in history, in my opinion, do you find that currencies are designed. Instead, you find that currencies co-evolve with the market. And even the way I look at them, the currency and the market are almost the same thing, or different ways of looking at the same thing. So when we think about the design of money, we need to think a lot about the law and what's legislated. You could think about the law of the marketplace itself as well. The power relations, so it's almost always the most politically powerful entity that gets to emit the money. You need to think about the needs of trade and the traders. Obviously, as well, there are security needs because sometimes money is stealable and sometimes it's not. Sometimes you need to think about the technology and the security as well. Although actually that's not a big thing in mutual credit currencies. In this presentation, I'm focusing on trade and the money which performs the function of trade because it has many other functions as well. And I'll argue that trade is the fundamental function of money because everything else that money can do can be done by other things as well. And so if money is going to specialize on anything, it should be serving trade. And also I'd like to introduce to you the idea of monetary mechanics, which is something I want to get into elsewhere. But we understand that money is a social system. But yes, it can still have mechanics within it. And I spend a lot of time looking at how the changes in the parameters of the design of money affect the performance of money and how it serves the marketplace. So the next slide, we're going to look at money in trade. So I want to look at a very simple trading relationship. When we think about trade, we think about handing over money in order to get something. and therefore money is that which pays for stuff. But this isn't really how trade has happened in history. Obviously, buying a cup of coffee, as in the picture, is within the definition of trade, but it's quite limiting. So let's step back and look at trade in history. So in history, trade was very much more between much larger entities than a person in a shop buying a cup of coffee. It was expensive. It was done by people with resources. And so you can see here there's a ship. Somebody's bought it or hired it and they've sent it across the world. There was a lot of risk involved. And when they send the ship out, they load it up with exports and they bring back a load of imports. And sometimes the value of the exports and the value of the imports wouldn't be exactly the same. And so you can see in the image, the gold makes up a bit of the difference. I'm not saying that gold is money. In this case, in trade, gold is just a convenient commodity that everybody can use. You can use it especially for settling the balance of trade, but it has other uses as well. And it's available in various quantities. So you could just use it to make up the value so that when you do a trade, your imports equal your exports. And in effect, that kind of trade doesn't even need any money as long as you can make it balance with the gold. So you can add up those trades over a period of years. And in this diagram, we can see different amounts of different amounts of goods and services going in each direction. That's symbolized by the width of the arrows. And then in each case, a bit of gold making it up. And over the long term, you can see that the gold sort of washes back and forth, and it's the same going in each direction. And you can even net that out. If the trade was perfectly balanced over the long run, you wouldn't need very much gold. You just need enough to make up the largest difference between one year and another. However, if the trade doesn't balance out over the long run, funny things start to happen. So in this diagram, A-Landia and B-Landia are trading. And after the first year, A-Landia runs out of gold. And so B-Landia lends them the gold. And that's what's happening in red. And so every year, the trade deficit from A-Landia is about the same, and they run out of gold, and then they run into debt of more and more gold. And so this is not sustainable at all. But what happens after B-Landia has started lending the gold to A-Landia is the interest creeps in. And so every year, the interest starts taking up some of the trade going in that direction. And the trade becomes more and more unjust. And so this is what happens every time there's a long-term trading deficit. This is why the IMF was created, to do that lending of gold from the surplus countries to the deficit countries. In fact, this leads to major political problems and problems in international relations and power imbalances as well. So I just want to leave that there and look at the four functions of money, again, very quickly. You've probably heard of the rhyme, money's a matter of functions for a medium, a measure, a standard, a store. That was adapted from William Stanley Jevons, who I think he first wrote down the four functions of money in the 19th century. I've identified that the four functions of money fit very well into this 2x2 grid. So the medium of exchange and the store of value, in those cases, the money is a thing which you either store or use to pay. But then there's the other function, the measure of value and the standard of deferred payment, in which case the money is not a thing at all. It's a sort of imaginary quantity of an imaginary substance. So you probably heard the story about the builders who were working on a house, and they went to the foreman and said, sorry, we can't finish building the house because we've run out of inches. Cue laughter. So that's trying to show the difference between the inches of timber that they would need and the inches themselves. So you don't run out of inches. And so money, at least in the modern definition, is doing these two things. It's both a thing and a unit for measuring value. And then money has the function now in the marketplace where you pay with it, and it helps you to exchange one thing for another, but you also measure the value with it. So it gives you a ratio of how much of one thing you can exchange for another thing. And then money has this function later where you're storing the value, and you want the value to stay constant as you store it. Or indeed, you're storing the debt so that there'll be a payment in the future. So I want to talk a bit about the medium of exchange function. I noticed that when you look in the dictionary, the medium of exchange is always the first function. And that's because, as I said earlier, it's the most important and most unique function that only money can do. I would argue if money is a medium of exchange, it follows that money itself is not the thing being exchanged. What's really being exchanged is what I produce in exchange for what I want. And money sort of sits in the middle of that. I've imagined marketplaces like this puzzle where you've got assets changing hands all the time. And money is the space through which the assets move. And so you can imagine if there's more money, go to the next slide, you see the tile disappears and it becomes easier for the assets to move around. And at the same time, I give the idea of the juggling man, because money is only really working when it's moving. When money is not moving, then it's being a store of value, which is a different function. In fact, you can't really separate the store of value from the medium of exchange function, because money is an asset and it's storing value, but it's designed to be very easily moved. We'll touch on that a bit later. When you do an exchange, you do so in a marketplace usually, and the money is a function, or it arises from the governance of the marketplace. So when you come to the market, you agree what you're going to use as a medium of exchange, and that's only really valid within that marketplace. And that means that the medium of exchange doesn't have to be valuable in itself. It can be agreed. You could say, well, we're going to use these tokens or these pieces of paper just as a placeholder, like the space in the elephant puzzle, just as a placeholder so that we can count what's been given and what's received. And so that we know at the end of the market, everyone has brought as much as they are taking away. And so if you think of money as just tokens or placeholders, then you start to understand that it doesn't actually have to be valuable. You can just receive it when you go into the market and then hand it back when you leave the market. And that might indicate as well that money is a sort of credit. But there's different mechanisms you can use. Modern economists really don't understand money as a medium of exchange. I had an email exchange with an economist called Mankiw, who wrote a book in Harvard. And he said a medium of exchange, is in his book, is an item that buyers give to sellers when they purchase goods and services. When you go to a store to buy a shirt, the store gives you the shirt and you give the store your money. The transfer of money from the buyer to the seller allows the transaction to take place. And that's his definition of a medium of exchange. And in that definition, he's so confused that he has made the money the object of exchange, not the medium. And he hasn't said what you produced. You had to get the money from somewhere first, and then you exchange the money for the shirt. And so even in the email exchange afterwards, he didn't seem to understand that money is the medium. He just thought it was a thing for exchanging in itself. Let's go on a bit and look at the store of value function of money. So I've mentioned that money is, by definition, it needs to store value between the transactions. But if you want the transactions to be separated by a long period of time, then other things come into play, because in a marketplace, all the prices are constantly changing all the time. And so if you want to provide something to the marketplace now and take something back from the marketplace later, the value of the thing that you provide will change over time. And so the store of value function of money is to enable that delay so that you get back in the long term what you put into the marketplace. And so the store of value function of money is all about money being stable over the long term. And to make that work, you tend to need large markets where you've got lots of prices that you can derive an average from. The government tends to work very hard to make its money stable store of value. And that gives rich people an option in the marketplace that they wouldn't otherwise have had. It means that the rich people, if they think that storing commodities is likely to be bad for them, if commodities in general are likely to go down, they have the option to store their value in money. And money is risk-free, at least in relation to the market, because effectively the government is underwriting it. And so the government interference, you might call it, in money by guaranteeing its value gives money another function. It makes money a long-term store of value, and that can distort the ability of money to perform its medium of exchange function. So in this slide, I put them on a scale, and money can be a good store of value or a good medium of exchange, but it tends not to be good for both. A good store of value might have intrinsic value in itself outside of the marketplace. And that might mean that it would probably mean that it's a commodity. So you need to acquire it and you need to keep it and look after it in the long term. And then you hope that it will maintain its value or even maybe increase its value in relation to other things in the marketplace. But a good medium of exchange, it has to be very easy to move from hand to hand. It also has to be available to anyone who wants to exchange. Sometimes when you exchange, you want to receive first and give later. And in that case, the money has to be available. When you have a commodity money and you want to receive first and give later, you have to pay to rent the money in order to be able to buy before you sell. That's maybe not optimal. A good medium of exchange also, it doesn't have to have value universally. It only has to work within the marketplace where people have come together to exchange. I want to talk a bit about the quantity of money. It's very, very important if you're going to have a well-functioning marketplace, think of the juggler, that he has the right number of balls in his hands. Otherwise, the pattern breaks and it becomes very difficult. So you can have too much money in the marketplace if the control over the monetary emission isn't being done in the interests of trade. You might have too much money. And of course, you can imagine that that leads to inflation. Or you can have too little money, which is the other picture of the river running dry, and that tends to lead to deflation. It's very hard to calculate what the optimum amount of money is, especially because people's needs to spend and to save are changing all the time. It's like the matter of national discourse. You know, if you've got a national feeling of optimism, economic optimism, people will want to spend. And whoever's in control of the quantity of money needs to respond to that kind of very, very soft and subtle indicator in order to make the market function optimally. Also, if you have more money and it's easy to trade, it means that it's much easier for people to pay back their debts. So people borrow money and then they depend on the marketplace circulating money for them to earn it back and pay back their debts. And if you have less money, then the people who are in debt struggle to pay back their debts and they compete with each other. And also the price of money tends to go up. And that means if you're a creditor, if you're in the business of lending money to people, you'll be very happy if there isn't enough money in circulation, because the price of that money, the price of lending, will go up, or the purchasing power of that money will go up. But if you're a borrower, you would much rather have too much money in the marketplace and see some inflation, because the inflation will inflate your debt away. And so we have this tension between the borrowers and the lenders in the marketplace, some wanting more money and some wanting less money. There's different things that affect the quantity of money, depending on the design of money and use. So, for example, if the money is backed by gold, then the price of gold is very important. If you've got a fractional reserve system, then the reserve ratio affects the quantity of money. Government can take money out of circulation by taxing, and they can put money into circulation by spending. And of course, the national balance of trade is likely to affect the quantity of money as well. Banking distorts the money system because it says you have a store of value in your bank account, but it's not actually storing the value at all. It's lending that money out to other people. And so it changes the quantity of money. It gives you interest, which incentivizes you to save the money instead of spend it. And I think of this as a layer of complexity and politics over the fundamental monetary mechanics, which change the behavior. And we have to understand how that works as monetary designers. So now I want to move a bit towards the credit theory on money. Hopefully you understand some of this already. The credit theory of money says that money doesn't have value in itself, but money is essentially a promise to give something valuable later, sometimes something very specific and at a very specific date. So issuing money as credit is as simple as making a verbal promise. But you can also write it down. There are checks, you can have IOUs, or things like bonds as well can be thought of as issuing money by making promises. And when you understand that money is credit, then you see that controlling the quantity of money depends on how many promises people can make or are allowed to make, or how many promises the market can absorb. So you see that there are different mechanisms for controlling the quantity of money according to what the money is. There's a problem, though, a difference between thinking about money as credit and thinking about it as a commodity like gold, because credit has an extra thing affecting the value, which is the risk. With credit, there's always a risk that it won't be repaid. And so you have to factor that in to the design of your system. You can compare the behavior of commodity monies and credit monies. So very quickly, again, just imagine that you've got some gold in your hand. And I'm not saying that gold is money, but gold is that kind of optimal design of money. When it's in your hand, you really, really own it, and you know that it's valuable and that it's yours. But on the other hand, if you've got an IOU in your hand, you don't really own anything. It depends absolutely on somebody else paying the promise. And if you look at the properties of the money system, they vary a lot between commodity money and credit money. So, the value of it is different because the commodity money depends on the market for supply and demand, whereas the value of credit money depends on the perceived risk of the issuer. Commodity money, when it goes on your balance sheet, is only an asset, but credit money is actually, it exists in two places at once because you've got the asset, but also the liability side. And when you add up the asset and the liability, of course, you get nothing at all. Commodity money, when you pay with it, you have to move the commodity from one place to another, but credit is just information. So it makes a much better medium of exchange for that reason. When you have a system of decentralized credit, that means that any producer usually can issue their own credit into the marketplace. So the credit is used to pay everybody's bills. It has to get back. Each bill of exchange, they're called, they have to get back to the issuer to be used to pay for products. And so you would have, in the Industrial Revolution, for example, credit markets where credit would change hands discounted, so that people who wanted to buy stuff from the issuer could buy the credit note in order to pay the issuer at a discount. So now I want to move on to mutual credit itself. I think about mutual credit as not so much as a type of currency, but as a style of accounting that emphasizes the balance of trade. So if you're looking for exchange, and mutual credit is all about exchange, you want to be able to see how much you've given in relation to how much you've received. And in mutual credit, that is zero or balance. Balance means you've given and received the same amount, and all the numbers in mutual credit are just indicators of the imbalance that help to guide you back to zero and back to balance. What makes a mutual credit different from the credit markets that I mentioned before is that all the members of a mutual credit network come together in solidarity, and they say, we will value each other's credit at face value. And that makes things much, much simpler, because it means you could just have a unit of account and everybody can write checks, and then the checks effectively change hands at face value. And there's no need to assess the risk and discount everyone's credit according to the perceived likelihood of default. Also, once you get into the mutual credit paradigm, you see that savers and borrowers are actually partners. They're not in competition with each other. As I explained earlier, you've got creditors and debtors, and they essentially make up two different conflicting social classes. In a mutual credit system, the savers and the borrowers, they need each other, because what the borrowers are borrowing is the same as what the savers are saving. And you can see that in the account sheet. And if there was no borrowing, there would be no saving. Usually mutual credit systems are used just for short-term trade liquidity. So you don't think of it in terms of borrowing and saving. You think of it as short-term spending before you earn, or earning before you spend. But it's still the same. Borrowers and savers need each other. And the credit that they create, I would argue, is a natural and obvious commons. It's governed naturally and obviously by the members. The members bear the risk. The members define it. And the members also decide how much risk they want to grant to each other. So I just want to show you quickly how a mutual credit balance sheet works. The table on the left is the actual ledger, and the table on the right is derived from adding up the columns in the ledger. So we could do a simple trade here where Alice gives Bob 10 units because Bob has given Alice some almonds, and you can see the balances plus 10 and minus 10, and they all add up to zero. And we can go through and we can add Bob and Charlotte giving Brazil nuts, and then Charlotte and Alice giving ceci. That's the Italian for chickpeas. And still, after all of those transactions, you can see that the balance adds up to zero. And so the mutual credit ledger just gets longer and longer and longer, keeps adding up to zero. And if at any time anybody gets their own balance back to zero, they can leave, because it means that their exchange, at least, is complete. So I want to argue that balance is everything in economics. If you want to do trade, you have to balance the trade. And there's a lot of economics around how you keep trading when there isn't a balance. So you could do things like lend money to the surplus surplus trader lends money to the deficit trader. You could do things like devaluation, but they don't solve anything. They just kick the can down the road, and eventually the surplus grows and the deficit grows. And with that, you have the inevitable balance of power between the surplus trader and the deficit trader being affected. And they're not on equal terms. And in the end, nobody's happy, because even the surplus trader can't sell anymore because the deficit trader effectively runs out of money. So it's important to notice in mutual credit that you see that supply and demand are in balance. You always have to bring the same amount of goods to the marketplace as you have consumed, and you always have to consume as much as you have brought to the marketplace. And this is a problem in fiat money. They try to balance supply and demand by getting the right amount of money. But in mutual credit, supply and demand are automatically balanced. Then you have the balance of power between creditors and debtors. Debtors always have enough credit within the system to be able to repay their debts, because it isn't being locked away in tax havens and lent back into the system as new credit. And you have also a balance between the surplus producers and the deficit producers. And so there's always the right amount of goods on the marketplace that everybody wants to produce and consume, as long as everyone comes to the marketplace with a commitment to consume as much as they produce. So coming towards the end, mutual credit design parameters, I've identified 6. You have to say what is the unit of account. I'll expand on that elsewhere. But for most systems these days, you want to use the national unit of account because that's what everybody understands. So you price things in dollars and everybody immediately knows how much they're worth. In a Let's system, you would use something entirely fabricated, and in a time bank, you use hours as the unit of account. But the most critical question is how much credit or debit can users hold? So that's called the credit limits, because that's how much any user will be allowed to default on and how much the other users will have to cover for them if they default. And so it's important that the users themselves decide that because it's their risk. And then you have to decide when somebody actually does default, because if somebody stops trading for a year, eventually you have to admit that they're not coming back to the system, and you need to get their balance back to zero through political means rather than through forcing them to trade. Then, of course, like any social system, you have to define the governance system. How are you going to make all those decisions? Are you going to involve really everybody in every decision, or are you going to have some kind of delegation or process? And finally, how do you achieve balance? It's very rare that you would create an ongoing exchange relationship and just achieve balance naturally. So you need to think about ways in which, when imbalances occur, what political tools are available to restore the balance. And that could be just saying to everybody, okay, this person's getting a bit too much into debt. Can you all try and buy off that person? Or it could mean investing in the deficit communities. Or it could even mean, if none of those are possible, writing off those debts and bringing the accounts back to zero through donations or some kind of insurance. I just want to say here as well that demurrage, which is often discussed in currency design, doesn't really apply in mutual credit. Demurrage is based on the idea that money is a commodity, and then you hear the talk about the commodity actually decaying and the value of the commodity going down. And that would be important if there was an incentive in the system for people to save. But since, as I've explained, mutual credit systems are balanced, you shouldn't need to bring in adjustments to the system like demurrage. So now I want to think about how you exchange between mutual credit systems. This is very well explored in conventional economics, and Mundell's trilemma identifies that you can't have these 3 things. Like, these 3 things are the holy grail. Free capital flow, that means you can buy and sell as much as you want in and out of your currency zone or your marketplace. So you can acquire lots of stuff from other markets, but also have a fixed exchange rate. That means you would keep the value of your currency the same in relation to other currencies and other marketplaces. And also, the sovereign monetary policy means that the people who issue the currency can decide on its value. So you can't have all of those things at the same time. What tends to happen in neoliberal economics and in all the economics going on today is that the top corner of that triangle is where the policies are formed from. And so it's all about allowing free capital flow between countries and not worrying about fixing the exchange rate, and certainly not worrying about self-determination of nation states. However, I'd like to propose that we build exchanges at the opposite end of the triangle, where we have fixed exchange rates, which means predictable prices, and we self-determine monetary policy within our groups. And what we give up is the free capital flow. Because, as I've explained before, if you can balance trade in the long run, you never need a commodity for settlement. And so if you're balancing trade in the long run, you don't need capital flow. You just need short-term making up the difference between year on year. So the Credit Commons is a way of joining together lots of exchanges using mutual credit. I've tried in this diagram to show the nested structure of the Credit Commons. That means that any exchange should be able to trade with any other exchange as long as they can make an agreement about how to do it. And that agreement is in fact another exchange. So you can have groups trading with each other and groups of groups trading with each other and groups of groups of groups. And each group has its own currency, its own governance, its own ledger. And the Credit Commons is a protocol to say how those ledgers would talk to each other. So the Credit Commons is not a software platform like a blockchain that says, hey, everybody, put your ledger onto this technology and it'll be safe. The Credit Commons is a way of one ledger talking to another ledger saying, can you register this transaction between these two accounts and keep the record in a space that we all control and trust? So it's very, very different to the whole trustless paradigm of blockchain. Bitcoin, you would think of it as a global money for anarcho-capitalists, and anarcho-capitalists love gold and they hate government and law. They think that your right to own gold is more important than government and the law. And I would say that the Credit Commons is the opposite paradigm. It's a global money for the solidarity economy, which is about making trade possible, but also doing so in a context of social justice. And compared to the anarcho-capitalists that use Bitcoin, I would like to think that the Credit Commons is something for anarcho-syndicalists, but you can form your own opinions about that. So in conclusion, the imbalance of trade, I think, is the root of all economic evil. Standard money, that's money as we know it, best serves those who would accumulate, indebt other people, and also try to obscure the fact that they're receiving more than they're giving. But mutual credit money is the natural choice for accounting for trade because it shows explicitly how much a person or organization has produced relative to their consumption. So, just to repeat it one more time, mutual credit springs from small trusted groups. It's inherently decentralized, bottom-up, governable, and resistant to centralized policy failures. And that concludes my presentation.